Welcome to Talk Tickers, your essential deep dive into the latest earnings calls.
Today, we are focused entirely on the JM Smucker Company's fiscal Q2 2026 results.
And our mission here is really to extract the crucial nuggets for you. We're talking the margin pressures, the big strategic pivots, and, the long-term story they're trying to tell.
So let's just jump right into the initial read, because the market reaction was, well, it was cautious.
It was. And it's interesting because if you just glanced at the headline numbers, the top line looked, pretty stable. Net sales at $2.33 billion.
Right, which is up 3% year over year, or 5% if you strip out divestitures and currency effects.
Exactly. So that revenue number landed right in line with what the street was expecting. No surprises there.
No, the top line was fine. The surprise, and the whole story really, came from the profit print.
Okay, so let's get into that.
Adjusted earnings per share, or EPS, came in at $2.10. Now, that is a very significant 24% decline from the same quarter last year.
24%. And even though that number was pretty much what analysts were expecting?
It was, right in that $2 and $2.12 range.
Right, but the sheer size of that drop is what created all the tension.
And you saw that tension immediately in the price action. The stock had a down day, and what really stood out to me was the volume. Turnover was nearly double the average.
So a lot of interest, but the interest was clearly negative. The market was punishing those pressure points on profit.
It absolutely was. And this just reinforces the narrative that Smucker is in a deep transition period right now. The stock has been lagging the S&P, and this result didn't help.
To understand that profit drop, then, we have to talk about margin compression. That feels like the real headline here.
It's the only headline that matters for this quarter. Adjusted operating income fell a steep 20%.
20%.
And adjusted gross profit was down 10%. These are just stark numbers, and they're driven by one persistent issue they have: the mix problem.
Okay, let's unpack that mix problem. So, is the idea that they're successfully raising prices, but it's not enough to cover costs and maybe a shift in what people are buying?
That's it, exactly. You nailed it. Their comparable net sales growth included a huge 11 percentage points from pricing. That's a success. It shows they have pricing power.
Right.
But that was massively offset by a negative 6 percentage points from a decline in volume and mix.
So what that's telling you is that people are paying the higher prices, but they're either just buying less stuff or they're shifting away from the premium high-margin products.
Exactly right. A little of both.
Right.
We saw this called out specifically in things like peanut butter, some of their snack items, and dog snacks.
And this is where the deep dive gets critical, though, because the single biggest drag on all of this was coffee. The coffee conundrum.
The paradox of the quarter right there.
Yeah, because the sales numbers looked incredible.
Fantastic. The U.S. retail coffee segment, so that's your Folgers, your Caf Bustelo, sales were up a shocking 21%.
But despite that incredible revenue growth, the profit for that segment it cratered. Down 24%.
And even worse, the margins.
Yeah.
Margins were down a massive 1,060 basis points.
Wow. A drop that big, it demands an explanation.
It does. And the explanation is that this was, believe it or not, an intentional strategic choice.
A choice. They chose to let margins collapse like that.
They did. It's a high-stakes bet. Management came right out and said they were absorbing about $75 million in extra costs, green coffee costs, and U.S. tariffs this winter.
And they're doing it without raising prices for you at the shelf.
Exactly. And that $75 million hit is mostly coming in the third quarter, so the pain isn't over.
So why? Why make that sacrifice? $75 million is a huge number to just eat.
It's all about defense. They're defending their market share and their brand equity. In this kind of inflationary world, consumers are looking for cheaper options, especially for a staple like coffee.
So they're trying to prevent people from switching to a private label or a cheaper competitor.
That's the first thing. And second, they're trying to prevent the volume losses that would absolutely happen if they passed on another huge price hike. They are very intentionally sacrificing profit today to make sure their brands are still the market leaders when this cost environment finally calms down.
So the bet is that the pain today protects their leadership position for the long run. And they actually had some data to back this up, right? Something about price elasticity.
They did. And, this is a subtle but really critical positive signal. They said their elasticity assumptions for coffee have improved a lot. They've moved from 0.5 down to about 0.3.
Okay, but put that in layman's terms for us.
So elasticity just measures how much volume you lose when you raise prices. So before, if they raised prices by 10%, they expected to lose 5% of their volume.
Okay.
Now, if they raise prices by 10%, they only expect to lose 3% of the volume.
That is a huge difference. It basically confirms their brands are stickier than they thought. People aren't leaving as much as expected despite all the price hikes.
Exactly. And that stickiness is why the coffee business as a whole is still expected to grow 16% this year. It's a massive 22% price increase, offset by only a 6% volume decline. The pricing is holding strong.
All right, let's pivot to some of the other segments because the profit issues weren't just in coffee. Frozen handheld and spread sales down 5%, profit down 12%. What happened there?
That one was mostly about what they call tough comps.
So difficult comparisons to last year.
Right. For peanut butter, they were lapping a period last year where everyone was stocking up because of some tropical storm, so that was an artificial sales bump they just couldn't match this year.
And Uncrustables.
Uncrustables, even though it's a huge growth engine, was lapping a really strong promotional event from last year's Q2, which made this quarter's profit look weaker in comparison.
Then you've got the sweet baked snacks segment. Profit there fell a stunning 69%.
Yeah, and when you see a number like that, you usually think something is structurally broken. But that 69% drop was way below what even they were expecting. And it wasn't about a collapse in demand. It was all internal execution issues.
Like what?
Supply chain problems, transition costs. Basically, they're still integrating recent acquisitions, and they had to close a big facility in Indianapolis. Moving production lines around is super disruptive and very, very expensive in the short term.
Is there any good news there?
There is. They said they expect a $10 million benefit from that factory closure to finally show up in the fourth quarter. So the segment should start to stabilize and get back to, low single-digit growth by Q4. It's temporary pain.
And all this transition talk brings us to the future, to their strategy. They've really simplified the story now around 5 core growth platforms.
Which, as an investor, is the clarity you want to see. The 5 pillars are Uncrustables, Caf Bustelo, Milk-Bone, Meow Mix, and the new one, Hostess.
It feels like they're going all in on the brands with the highest growth potential.
That's exactly what it is. And you can see the momentum in some of those brands really offsetting the weakness elsewhere. I mean, Uncrustables is the engine.
It absolutely is. It grew 7% this quarter, and it's still on track to be a billion-dollar brand by fiscal 26.
And this isn't just selling more of the same. It's innovation. They're launching high-protein breakfast versions, limited edition flavors.
Yeah.
And the distribution piece is key. Sales in convenience stores nearly tripled.
Wow.
Yeah, they expect to be back to low double-digit growth in the second half of the year.
Caf Bustelo was another huge bright spot, 41% net sales growth. And importantly, that included 9% volume growth. Actually, getting more volume in this environment is a very strong signal.
It's a signal that they're getting into more households. The strategy is working. They're moving beyond their old espresso base and making roasts for regular drip coffee machines. It just opens up the brand to way more people.
Okay, and what about the pet segment? That's been a challenge for them in the past.
We saw some real sequential improvement there. The portfolio is looking healthier. Meow Mix is still outgrowing the category, and they expect Milk-Bone to return to growth in the second half.
So the overall picture is pretty clear. They're pushing growth in these key brands while taking this big strategic cost hit to defend their position. Which brings us to the guidance update. That was the source of the market friction.
Yeah, the guidance was tightened, and that always makes the market nervous. They're now calling for comparable net sales growth of 5 to 6%.
And the EPS number.
That's the one that mattered. They tightened the adjusted EPS range to $8.75 to $9.25. And the midpoint of that range is just a little below what the street wanted.
And they were pretty clear that the lower number is a direct result of those coffee costs?
Yep, higher coffee costs and continued brand investment. The market hates the pain today, but management is trying to set up a much cleaner story for the future, especially with the balance sheet.
Their focus on paying down debt?
It's paramount. It's the alternative catalyst for investors who can look past the current margin mess. They're aiming for $975 million in free cash flow this year.
And a lot of that is going to debt reduction.
About $500 million a year is being prioritized for debt. The goal is clear. Get leverage down to about 3x by fiscal 27. That's a huge structural improvement from the 4x they're at now.
And this all ties back to that massive coffee tailwind you mentioned for FY27.
It all connects. That $75 million in costs they're absorbing this year, it just sets up a clean, easy win for next year. They expect those 40% tariffs on Brazilian coffee to be removed, which will give a huge built-in boost to the bottom line in FY27.
But wait, calling it a strategic sacrifice is one thing, but aren't they relying on a political action, the removal of a tariff for their future guidance? That seems like a big gamble. What if the tariff stays?
And that is the absolute core risk that you as an investor have to wrestle with. The assumption that those tariffs go away is baked into the cake. It's built into the expectation of cleaner earnings down the road.
So if that political calculation is wrong or just delayed,
Then they lose that $75 million tailwind, and the whole story for the stock's re-rating is compromised. It forces them to find that growth from operations alone, which is much, much harder than just having a huge cost disappear. It definitely creates tension in the investment thesis.
that tension really does sum it all up. You have management focused on brand strength and paying down debt, and you have the market fixated on the 24% profit drop today.
The narrative arc is simple. Take the pain now, use the cash flow to clean up the balance sheet, and then rely on known catalysts, like that tariff reversal, to drive a big jump in earnings in FY27. The market sees a mixed quarter, we see a strategic shift.
So if you're an investor and you believe that story, that they will hit the debt targets and that tariff will go away, how do you actually trade that idea?
Well, this is where we shift to our regular segment. This is not financial advice. We explore a plausible, maybe even a little outrageous trade idea to capitalize on this exact shift.
All right, lay out the premise for us. We're betting on the future, not the present.
Exactly. The idea is that the stock's future earnings power is structurally cleaner than its current price suggests. The pain in Q3 is known, it's quantified, it's in the guidance. The upside in FY27 is also pretty well defined.
So what's the asymmetric trade pitch? How do you play that?
The pitch is a long-dated asymmetric call spread. So you're looking way out on the calendar, maybe to a Q1 fiscal 2028 expiry,
Okay, so more than a year out.
at least. And you buy a call option that's significantly out of the money, let's say a $115 or $120 strike price. And then you sell an even further out of the money call to help pay for
So
it.
you're minimizing your cost to get into the trade today.
You're minimizing the capital outlay now, but you're maximizing your exposure to that big re-rating of the stock that's most likely to happen when they report earnings next spring and finally give official guidance for FY27.
It's a very clear bet on that structural improvement materializing about 18 months from now.
Precisely. You ignore the noise of the next couple of quarters and bet specifically on the leverage target being hit and the tariff benefit being realized.
Excellent analysis. So to recap this entire deep dive, James Smucker had strong sales in its key brands, Uncrustables and Caf Bustelo. But that was completely overshadowed by a deliberate strategic sacrifice of profit.
They're absorbing $75 million in coffee costs to protect their brands, and that sacrifice sets up a very clear non-operational profit tailwind for fiscal 27, all backed by strong free cash flow and a commitment to pay down debt.
Management is absolutely trading near-term pain for long-term gain.
Which leaves you, the listener, with one final provocative thought to consider.
And that is, how much of that $75 million tailwind from the tariff relief in FY27 will management actually let flow down to the bottom line? Or how much of it will they just immediately reinvest into those growth brands to try and accelerate their leadership even more?
The answer to that question is what will dictate the true long-term earnings power of this stock beyond this messy transition year.
As always, remember that everything discussed here is for informational purposes only. This is not financial advice. Thank you for joining us for this deep dive.
We'll see you next time on Talk Tickers.